Good afternoon, everyone. Good afternoon. My name is Alam, and I'm your host for today's session. I'm an alumni. I graduated from the BCom, formerly known as BS, in 2017 from York University, and I'm currently a finance manager at Moneris, which is a payment solutions company. So happy you could all be here today for our alumni webinar, Investing, Where to Start. GRADitude provides alumni with the opportunity to learn alongside and connect with fellow alumni, and especially warm welcome to our recent grads. Welcome to a family of more than 350,000 alumni living and working around the globe. Before we start the session, I want to begin by offering York's land acknowledgement. Although we aren't all in the same location, we recognize many Indigenous nations have long-standing relationships with the territories upon which York University campuses are located that precede the establishment of York University. York acknowledges its presence on the traditional territory of many Indigenous nations. The area known as Takaranto has been caretaken by Anishinaabe Nation, the Haudenosaunee Confederacy, and the Huron-Wendat. It is now home to many First Nation, Inuit, and Métis communities. We acknowledge the current treaty holders, the Musqueam Nation. The territory is subject of the Dish with One Spoon Wampum Belt Covenant, an agreement to peaceably share and care for the Great Lakes region. If at any time you need help with the experience or have questions about the content, feel free to click on the Q&A button on the bottom of your screen. Our team is ready to help you. Before we get started, I'd like to ask you what you hope to get out of the session today. Please use the Q&A function to let us know what you'd like to learn. Take a moment to read through some of the comments we have on what the audience would like and hope to get out of the session. Feel free to click on the Q&A button at the bottom and share your thoughts. In the meantime, I mean, definitely although I'm one of the hosts, I'm looking forward to learn more about investing, and especially given the markets, everyone's talking about the markets quite a bit, just understanding how to invest and how to get started. And I mean, as a young alumni, many times, many of our audience members would be students, just getting started and seeing where to start. It gets quite overwhelming, right? And especially when you put in your money, it becomes real. So definitely looking forward to learning more about it. We had a question, will the recording of the session be shared? Yes, it will be available on YouTube after the fact, but it is now being live streamed as well. All right, we shall get started. Thank you so much for your contributions, appreciate it. Now I'd like to introduce our guest speaker for today, York alumnus Fahad Rana. Fahad, please turn on your camera and mic and join me on our virtual stage. Welcome. So great to have you join us for the session.
Thank you for having me.
No problem. Before we begin, let me just share a bit about you so the audience is familiar about your background. So Fahad is a portfolio analyst and a trader at Scotiabank. He graduated from York with a bachelor's degree in economics from the Faculty of Liberal Arts and Professional Studies. He's here to discuss a range of topics for beginners, including how to invest and what vehicle to invest in, and insight on where to focus your money when starting out. Well, Fahad, the floor is all yours.
Thank you, Alam, for that introduction, and thank you for having me. And it's a pleasure to be able to connect with York since graduating. Been connecting here and there, but never at this level, so I'm very thankful for this opportunity. I'll start by sharing my screen. You can see my slides, right?
Yep, we can see the slides.
Perfect. And is this panel on the right only visible to me, or are you also seeing the names on the right?
We can only see the slides.
Okay, perfect. So I'll start by just giving a short introduction of what we'll cover. I have the agenda here. So, investing is something that everybody thinks about. You read the news. Oh, there's been a Bank of Canada has put up a rate hike. What does that mean? Inflation is occurring. What does that mean for me? People are buying more homes. The real estate market is hot. What does that mean for me? So there's always something investing related that is coming up in the news. And we live in Canada. We live in a great country where we have a lot of options available to us in terms of investing. We have one of the biggest financial markets right next to us, the US, available for investing as well. And we are very lucky to have a very well regulated and safe banking system that facilitates all our monetary transactions. And luckily, we also have access to a huge amount of information. But it's hard to narrow it down as to what is relevant to you. Obviously, there's a lot more that we can go into beyond the scope of what I'll cover, but I've tried to focus on what is really relevant to us as young alumni or just as people looking to start investing. And I hope that this will be of value to you. So I'll start by, why should we invest? And obviously we can't talk about anything without talking about taxes. So I'll cover that. I'll mention two main tax options that are available to us in terms of, and that relate to investing. And then also a little bit on, what to invest in, how risky is it, and how much do you need to start? And also how can you get started, banks, brokerages, and so on. So we'll cover this. I hope that I'll be able to, I've tried to keep the jargon and the terminology simple as it can be. Just so we can cover a lot more in the simplest way possible, and it's easy to absorb. You don't need to spend a lot of time thinking about it. And I've used some visuals as well, so hopefully those will support my ideas. So let's start. Why should we invest? We've seen inflation, the inflation rate hitting now 6.7%. As of the March statistics that I gathered. What does inflation mean? So, back in the day, I'm sure you've heard all those stories, your parents saying, oh, you know what, back in the day, I could get a watermelon for like 2 pennies and 2 pence or like 2 cents or whatever it is, the currency that you relate to, obviously Canada, 25 cents for a cup of coffee as per the chart, as per the visual that I have here. And now, if you go to Starbucks, you're looking at, a nice frap will at least ring you, $5 to $6 and, exceeding $7, depending on how many pumps and, whipping cream and all that stuff. But essentially that is inflation. If you look at, your trolley, when you're going for groceries, everybody usually does groceries on a weekly basis. When I went for groceries last time, I spent around $70 to $80 and I got maybe 10, 15 things. And they'll last me maybe 10 days. And back in the day, if let's say in the 80s or the 90s, the previous generation, or I guess even earlier millennials, they were able to afford a lot more. And not just that, even early 2000s, our money could go much further. And obviously there's a lot of reasons that, I'll touch upon some of them. But essentially, if the inflation rate is 6.7%, what that means is $100 for you now is 6.7% less powerful than it used to be. So if you're trying to maintain, the same lifestyle that you have currently, if you're trying to, spend time with your friends at your favorite restaurants, buying the same level of groceries, buying the same things, then you have to have something that will replace that purchasing power that you've lost. So that's why we invest. Now, I have a chart here that just covers, the inflation rate in the last 12 months, right? And you'll see it's skyrocketed since, the pandemic started, which makes investing all the more important, although confusing. And obviously we know why. The markets have been, on a roller coaster. And but at the same time, it's really important for you to make sure that you add value to your bottom line. Your bills and all of your bills, the biggest bill, being rent, for example, and the other ones being utilities and all of that have not gone down. They've either increased or stayed the same. So your purchasing power has declined. If it feels so, it's because prices are getting more and more expensive, products are getting more expensive, and that adds to, when you go out to eat, their menu prices are changing. If you buy groceries, you're getting less in your trolley. If you are buying a flight, the flights are now, more expensive because of fuel. So a lot is going on in prices, and it's usually because of, rising input costs, right? So with airlines, one contributing factor is, high demand, but also fuel. So we know fuel issues are occurring because of the conflict in Eastern Europe, in Ukraine. And also, for example, coffee, as I mentioned earlier, was one example. Coffee costs have increased over the last few years because of the conflict in Yemen. So, any sort of world events can contribute to rising input costs, which increases the cost of production. And, the final end consumer will see that their restaurant is charging them more, their airline is charging them more, so on and so forth. And obviously, the pandemic has accelerated supply chain issues. I'm sure we've seen that that image of tankers, like oil coming in on ships, and the ships are just waiting outside of a port in Miami, and it looks like a sea of ships, right? So, and there was just not enough capacity for ports to bring all that oil in, and that led to different issues. Now, these supply chain issues have accelerated. Right now in the US, there is talk about, baby formula, formula powder for babies. And, parents are worried, where do we get formula from? I heard today that Europe might start shipping out more excess baby formula to the US. So that is one factor. The others would be obviously trade agreements. We know Britain exited the EU. That had its own impacts. Under the last US government, trade agreements with Canada were changing. And then obviously we have monetary policy. What does the Bank of Canada want what is the spending level that Bank of Canada wants people to be at? Do we want to regulate more spending? Obviously, given the current climate, with high prices, people are trying to save more. And the only solution is the government of Canada wants us to spend more. So they may have to, institute a monetary policy that can make that happen for us. So these are some of the factors why inflation is increasing and the factors that can influence inflation. But now we'll continue on. And obviously, we can't talk about investing or really anything else in Canada without talking about taxes, right? The main reason I would say why you should worry about taxes is basically in Canada. I'm no tax expert, so anything I take can be verified again. But as far as I know, any appreciation that you get on your investment, say, for example, you had, Apple stock, right? And your Apple stock you had a profit on your Apple stock investment for like $50. Now, half of that $50 is subject to capital gains tax. What that means is $25 out of the $50 that you have is going to be taxed. So to avoid that, and obviously $25 is a small amount of, just an example, but you say you have a $10,000 portfolio, $20,000 portfolio in total that you have invested, that can add up, right? So that can eat into your return. So, inflation this year is averaging around 6.5%. Optimistically, it's higher now, but optimistically. So if your return is higher than 6.5%, these taxes can dig into that. And, now you might still be losing purchasing power because your ultimate return is now below 6.7% because of taxes. So there are some tools that obviously we have to help us here. To avoid paying tax on investment income, I would recommend everybody have a TFSA. Everybody. Now, what is a TFSA? It's basically a savings account offered by the government. It's available at all financial institutions. So, your bank, also through brokerages, so online, Wealthsimple, Questrade, and all of these options, they all offer these accounts. You can open one, it's free. All they need is your SIN number. And once they have your SIN, what that means, these are called registered accounts. What that means is this account gets registered under your SIN number with the government, and you do not have to pay tax on any investments that you hold under these accounts. Now, obviously, you would be like, why would anyone invest outside of these accounts, right? Why shouldn't we keep all our money in our TFSA? There's a catch. The government doesn't allow you to put all of your money in your TFSA. Otherwise, they wouldn't recover any tax. So there are limits on each year how much you can put in. There's only so much. I've just taken this screenshot from the Government of Canada website. If you look at the last year the limit was 6,000. The year prior 6,000, and 2019 as well. And it goes up, 5,500, 10,000, so on and so forth. The way this works is, let's say you turned, this is basically, you can start contributing once you turn 18, or if you come to Canada, let's say in 2014, then your contribution room would start from there, and it adds up. So let's say you came to Canada, or you turned 18 in 2013. Now 5,500 for 2013, and you never had a TFSA, so you would have 5,500 plus 5,500 plus 10,000 plus 5,500 plus 5,500, so on and so forth for each year. You can carry that over, and if you haven't contributed ever before, you can start now. The only thing is just make sure you don't exceed your contribution room, because there is a tax penalty for that. I think it's 1% per month or something like that. Again, you can always check that on the Government of Canada website. And essentially, the TFSA does not limit you on withdrawals. You can withdraw your investment anytime you want. And let's say you had an Apple stock or a mutual fund, or any of your investments in a TFSA. When you withdraw it, you do not have to pay tax on it, even if your investments have grown. So this capital gains tax that I mentioned earlier, this does not apply. So it is very beneficial. Everyone should have it. Even if you don't invest, just keep some cash in there. And so, when you have your answers and you have your questions answered and you have enough knowledge, you can start investing right away. So everyone should have one. The other option now, in addition to a TFSA, if this situation works for you, is an RRSP. This is also a registered account. So it's offered the same way through your bank, through your financial institution, and you can contribute to your RRSP. Again, the limits are on the Government of Canada website. The only caveat is that once you withdraw from your RRSP, it's considered taxable income. So it will be taxed in the year that you withdraw from it. Now, usually people, use an RRSP, a retirement savings plan, to plan for their retirement. So the idea is, right now you're making a lot of money, you have a higher tax rate. At retirement, you will have a lower tax rate, and all this money that you've now saved up and that has been invested and growing can be withdrawn when you retire at a lower tax rate, when your income might be close to zero or might be very low. And the benefit of an RRSP is that, let's say if you contribute to an RRSP, you get a deduction for that year on your taxes. So there's a tax benefit. When you contribute to your TFSA, there is no tax benefit. It's just like a regular savings account with limits on it. In addition to these, there is obviously another registered account. It's called an RESP, Registered Educational Savings Plan. It is beyond the scope of this presentation, because it has additional tax rules, and basically you can get certain grants from the government, and usually registered educational savings plans are opened by parents for their kids or grandparents for their kids, where they can contribute a certain amount, and that is matched by the government, but that can only be used for educational purposes. So, and in addition to these registered accounts, obviously you can invest your stocks, your mutual funds, your assets outside of these in non-registered accounts. The only thing though is the capital gains tax will apply. And there are no withdrawal limits, obviously, because you can take your money out whenever, you can put it in whenever, and there are no tax considerations in terms of withdrawal limits. However, the capital gains tax applies. So any income that you would get or any appreciation in your assets that you would get would be taxable. Now, there are other tax considerations beyond this, and there are other methods beyond this that you can look into, but I would consider talking to your tax accountant or your tax lawyer if your situation is much more advanced than this. So I'll proceed and I'll move on to this visual that I have. And I like using this visual because this will sort of summarize what a TFSA or an RRSP is, what's the difference between using these to hold your investments and your, if you're holding without them. So, you've got your taxes here raining on you, and think of these registered accounts as an umbrella, which will shield your returns from any tax considerations. Perfectly legal tax evasion. Now, this any sort of TFSA or RRSP that you hold will protect your investments as long as the funds stay inside, especially for an RRSP. So if once you withdraw money, again, that's taxable for the year that you withdraw it in. For a TFSA, you can take your money out, no problem, anytime. And any amount that you take out, you do get to contribute that back into your TFSA, but it's usually the following year. Just something to remember. And if you invest outside of our registered accounts, then obviously your returns and your appreciation and your income is taxable, 50% at that capital gains tax rate that I mentioned earlier. So just a quick visual, just to summarize, our discussion on this. I'll move on to, what to buy, how risky is it? So luckily in Canada, we have a really developed financial services market, and we have developed markets, we developed assets, developed regulations, and a lot of options available for us to purchase. Now, the simplest option that everybody hears about is stocks, right? What is a stock? So a stock essentially gives you part ownership in a company. I'll use Tesla or Apple as an example, the most famous ones. So, if you buy a Tesla stock, you are a part owner in that company. If you buy an Apple stock, you're a part owner in Apple, so on and so forth. Now, when you buy a stock, you typically expect it to rise, and you do your research, and you are, because the thing with stocks is, the main thing with stocks is your purchasing power is dictated by the price of the stock. So I looked today, Amazon was at was crossing $2,200, right? USD. Now, that means one Amazon stock is going to cost you over 2,200 US dollars, one stock. So obviously that is very high risk. You're only investing in one company, and if that is all the money that you've been able to save, you should not do that. The reason being, there's a potential for large losses. Say tomorrow, Elon Musk is very excited about his Twitter purchase. Say tomorrow he goes to Amazon, right? Obviously, ignoring the practical implications of that and the fight that he would have with Jeff Bezos. But say he was to ever do that, and for some reason, Amazon stocks went crashing because Elon Musk didn't do that great with that purchase. That would not limit your losses to, there would be no bottom limit. You could lose everything if that one company goes down. So there is a potential for large losses. Obviously, that does mean there is a potential for large gains. So say, Elon Musk bought Amazon. He did really well with it. And now Amazon stock has doubled. Your profits would essentially double. So there is a potential for large gains. There's a potential for large losses. The only thing is, buying the perfect stock takes time. And there are people who day trade, they don't do anything else. Some people will just sit and they will watch the market all day, and they will make their investments accordingly. Someone like me or someone like you, if you work a full-time job and you have family commitments, you may not have all that time to always watch the market and to make investments accordingly. So this is not for everyone. Buying stocks is not for everyone. It is if you have time. It is if you have the funds, and if you can take the risk. And there is a potential for large gain. And also stocks do pay dividends. So what that means is, say Apple or Amazon were making a profit, they could share a part of that profit with you. So in addition to, the stock price increasing, you could also get a small amount of income from their profits. So there is a section of financial advisors or, asset managers, or these people who do focus on dividend paying stocks to build you an investment that is income generating. And this is particularly important for people who are, they are relying on their investments, such as people in the older age of in their older age, or people who are on the lower end of the spectrum who do not want to take that much risk. They also rely on dividends, although they wouldn't invest only in stocks. They would typically diversify their portfolio. What is diversification? Remember how I said if you had only $2,200 to spare, and if you bought Amazon, that's all of your money in one company. Now that is risky. You've only bought one company. So anything that happens in that company will affect you or your life savings if that's all you had. So there is no diversification, which brings us to the next option, which would be mutual funds. What is a mutual fund? Easiest way to describe it would be it's a pool of funds. Say I contribute to it, you contribute to it, Alam contributes to it, and a lot of other people contribute to it. But I can only do $10, Alam can do 1,000, and someone else can do 100,000. So what this fund will do, it will go out and buy stocks that it will hold, that it will own. But it will only assign ownership to you based on your initial investment. So if I only put in $10 into this mutual fund, I only have $10 worth of units. And what mutual funds do typically, they invest in a whole basket of stocks. So it's not only buying one stock, it's buying a basket of stocks. Because don't forget, if you wanted to buy $2,200 worth of stocks and you were to buy individual stocks, you would be able to buy maybe 2 or 3. If you don't go for Amazon, you go for something else, 3 or 4 stocks. And again, that's not great diversification. That's okay. And you can build a portfolio like that. But with mutual funds, you would be able to diversify it much more. An average mutual fund has upwards of 25 stocks, and they diversify it across, different industries, the banking sector, technology, utilities, financials. Now you see it. Now you're beginning to see ESGs, which are environmentally sustainable securities as well. So a mutual fund is a much safer option than stocks. It is not 100% safe. There is a level of risk to all kinds of investing, and obviously I'll talk about this in a moment. But mutual funds are less risky than individual stocks. They are also low cost. So let's say if you went to your bank today, the easiest way to buy mutual funds is, it's through your bank. And if you went to your bank today and you wanted to buy, say you had $1,000, you would be able to get in at $500. The minimums usually for mutual funds, at least in my experience in Canada, are usually $500. And then after that, it's not like you have to keep contributing $500 each time. After the initial investment is $500, and then it's $25 that you can keep adding. And the best benefit is instant diversification, right? As I said, they invest in a whole basket of companies. It is less stressful. They do all the work for you. You do not have to sit down and choose each fund. It's like going to McDonald's and getting a combo. You do not have to put all the ingredients together. And you also get dividends. Now, in a stock, these might be paid out to you, depending on how it's set up. In mutual funds, it's usually reinvested into the fund. So think of it as a snowball. Your snowball is paying you dividends, and it's just growing, and as it's rolling down the mountain. And the good thing with mutual funds is the access. So say, if tomorrow you wanted to get further answers after this presentation, it's got you interested, it's got you thinking, you could make an appointment at your bank branch and go in and talk to those guys and see what they offer. Mutual funds are typically available at every single bank branch, and almost every single bank works with mutual fund companies to make these available because they're the easiest and most popular form of financial product, and the fastest growing form of financial product. Now they're being overtaken by ETFs, which we'll talk about next. Now, with mutual funds, there are some caveats. It can underperform markets. There are very few funds that can underperform a market. What that means is, say the market did like 5%, right? A mutual fund may only do 2 or 3% if it's active, which means, if there's somebody sitting behind a screen buying and selling funds constantly, it can underperform. Typically, with mutual funds, you have to think about, is it passive or is it active? So an active is, someone sitting and buying individual funds, individual stocks, and passive is, what they'll do is they'll replicate a stock market index. So, say S&P 500, Dow Jones, or in Canada, TSX, they'll replicate that, and the mutual fund will artificially try to track that index. So there's not a lot of selling going on. And basically, with a mutual fund like that, you will end up at least making what the market is making. And typically, you may not make, a 6-7% return, like inflation is abnormally high, but you will make a sound amount of return that you can use to, get to your financial goals or to save for your retirement, whatever that might be. Now, if you have mutual funds outside of your tax-free savings account or your RRSP, I would recommend that you don't do that because that will be taxable. So, any dividends that you get will still be taxed in your hands. So we'll move on. What is an ETF? An ETF is an exchange traded fund. They're basically traded like stocks. Now, they are less risky as well. Excuse me. They are less risky as well because they are structured like a mutual fund. And you can get instant diversification. So say I have an example here, the iShares Core S&P TSX Capped Composite Index ETF, mouthful, but what that means is it tracks the top companies in the S&P and TSX, and also what it does is it diversifies. So it's not only investing in one company, it's investing in the top companies in those indexes. And there's no commissions, there's no loads on it, and you can buy this typically for free through usually through a online brokerage, which means your online Questrade, iTrade, whatever that might be. This is typically not available in your bank branch. Bank branches do not typically make any money from this, so they would not offer it to you. It is easy to trade. You can put a trade in yourself, and you can research, which is the best ETF. Vanguard is a popular one, and there is a very low minimum investment. Like you can literally invest with $10, $5, whatever that might be, because basically you're investing in a fraction of it. There's only a few brokers that may not allow you to buy fractional shares. Mostly you can invest in an ETF at a very low investment. The other thing is some brokers might sometimes charge a redemption fee. Like if you withdraw it within 30 days, they may charge you a redemption fee, an early redemption fee. But again, you have to check with your broker. So this brings us to, you might all be thinking, okay, so we've covered stocks, we've covered mutual funds, we've covered ETFs. How much money do I need to start investing? With stocks, it's dictated by the price of the stock. With mutual funds, it's typically at least $500 at your bank, and then it's $2,500 after that. With ETFs, it can be as low as you go, as low as $1 and as high as you like. But how much money do you need really to start investing? And to help me answer this, I'll get your help. I have this question up on the screen, and I want you to answer it. And there should be 3 options there. So on average, how much are you able to save consistently? Is it $0 to $500 per month? Is it $500 to $1,000 per month? Or it's over $1,000 per month? And for some, this might be 0 on some months. For some, this might be 10,000 or more. It really varies depending on how much you make. Okay, so we have some answers here. So $0 to $500 per month seems to be the majority of group. I would place myself in this group too. 500 to 1,000 per month, 22%, and 1,000, 17%. So most people seem to be saving $0 to $500 per month. And that's fair, right? Because we have, Canada has some of the highest prices in the world. And at the same time, incomes are not growing fast enough. And that obviously creates conditions where we are only able to save so much. So the reason I asked this question is because basically, if you had your TFSA or your RRSP, you could put that money in there, whenever you can. Say you got a paycheck, you could, before you pay your biggest bills, before you pay your rent, before you pay your utilities, so on and so forth, the first thing you should do is pay yourself. Put that $50 or $100, however much it is that you're able to save in your TFSA or in your RRSP. And obviously it also depends on what you're buying. So we discussed the minimums for mutual funds, ETFs, and stocks, and you can purchase that under your TFSA or RRSP on an ongoing basis. Now I have a second question here. What's the longest amount of time you have gone without needing to dig into your savings for any reason? So if you have your nest egg, how long have you gone before digging into it? Is it less than 1 year, 2 to 5 years, more than 5 years? So we have some answers here. 39% said less than 1 year, 33% said 2 to 5 years, and then more than 5 years, 28%. So a more balanced response here. So I'll discuss what that means for each group. So say you were only able to save for 1 to 3 years or less than 1 year. I would personally recommend that you do not invest in the financial markets. Now, what that means is don't buy, any mutual funds, don't buy any equities, don't buy any ETFs. And the reason I say that is because markets are very volatile. What that means is basically if you invested $50 today and you needed it, say next month, you overwent with your spending, or there was an unforeseen expense that came up and now you need to dig into it and you need to withdraw those funds, the market might be down. And if you take your money out at that time, you might lose. So if you have a short time horizon, if you have a shorter time, I would say do not invest in the markets. Consider GICs. Basically, you can put your money with the bank and they'll pay you a certain amount of a certain investment rate. Or banks usually have a savings account that you can put your money into, and they would give you an interest rate based on that. So consider those. If it's for 3 to 5 years, you can invest in the markets, but always have I would say no matter what, always 1 to 3 years, 3 to 5, 5 to 7, or even more than 7, always have a backup, always have some cash tucked away somewhere else that you have not invested for those urgent expenses or your unforeseen expenses. Because the thing is, the markets work out well if you invest for the long term, but there is no promise on a positive outcome if you invest for the short term, and I'll explain that more further. So this is, the S&P 500. This is, one of the more popular indexes. If this is a 1 year return. So if you look at this graph, essentially, if you invested here at this point in early, mid 2021, by the end of 2021, your return would be, if you invested here, your investment might have grown just a little bit. If you invested here, however, in September 2021 and withdrew in about 4 months, you would have lost money. And now if you've kept that money in for longer, a little bit longer, you've seen that it's recovered. Now, obviously, this is 1 year. Let's look at the 5 year. So if you look at the 5 year, the picture looks a lot better. So, say you invested in early 2020 when the pandemic was starting up. The market obviously crashed. You would have seen your portfolio decline. You would have lost everything if you invested here. However, if you left it for a while, you would have seen that it not only met what you had invested, not only did it just come back to that, it kept rising. So given more time, your investment will grow. But given less time, your investment can tank. And you do not want to rely solely on the market doing well, because there is no guarantee of a positive return in the short term. In the long run, there is a guarantee of a positive return. If we look at this graph even further, you would see that it's risen consistently. So I hope this kind of summarizes and explains the time aspect of investing. Basically, if you want to have more time, that will be better for your portfolio. If you have less time to invest and you may need the money sooner, consider other options or consider a balanced investing strategy. Don't put all your money in stocks only. So what are some options that we have for investing? I'll get into it a little bit further. Obviously, I mentioned some, Questrade, iTrade, there's Qtrade, Wealthsimple Trade, and then obviously we have CIBC Investors Edge. Typically, if you bank with the big five here in Canada, they all have their online, brokerage systems. I'll go through some examples here, and I'll tell you why they might be better suited to some, and some might be better suited to others. So say Questrade, right? Now they do have an account minimum. So that means to invest with them, you need to have $1,000. For these other ones that I have here, as far as I know, there is no minimum. It's 0.000 here as well. And some of them don't charge any commission on certain securities. So you'll notice here, neither of these charge anything for ETFs. So there's no transaction fee for buying ETFs. And some of these are cheaper. So Questrade, they have minimum $4.95. And Wealthsimple right now, as far as I know, is the only option. Wealthsimple Trade is the only option that allows you to trade stocks for free. It does not have a commission. The way they make their money is, if you buy, being a Canadian, if you buy US stocks, they do have a higher margin on converting from USD to Canadian. So they do charge a higher margin there. But if you're just buying Canadian stocks, you should be paying nothing if you go with Wealthsimple Trade. And obviously, like I said, they all offer TFSAs, RRSPs. So all of these will offer that. Some of them do have an inactivity fee. What that means is, say in the case of Scotia iTrade, you do not have any activity in a quarter, they will charge you $25 for that quarter. Obviously, if you have, $25,000 in the case of Qtrade, they would not charge you anything. If you have iTrade, $10,000, they would charge you anything. And there are some of these options that are really unique. For example, if you consider if you consider social values that will dictate your investing, just like they might, in other aspects of your life, religious reasons or environmentally sustainable, so on and so forth. As far as I know, Wealthsimple Trade is the only one that offers halal ETFs. So, say you want to avoid any interest-based companies from being in your portfolio, you could look at Wealthsimple as a viable option. I haven't seen a halal or a Sharia compliant or a religiously aligned investing option in any other institution so far in Canada. I know they might be working on it, but we'll just have to see when they come out with that. There are environmentally sustainable options available at these brokerage options that you can always look into. And the good thing with one of these that I want to mention with iTrade is they give you a practice account, and I've used this myself. Basically, for free, you get a practice account. You have so-called virtual money that you could invest, and it basically tracks real market. So before you put in any real money, you can play with that and see how comfortable you feel and how it reacts, and to gain a better understanding of how the market might be. So these are just some options. Obviously, there are more. These are just some that would give you a little bit of an idea as to what are your options. And just some final tips that I want to cover is, automate your savings. So if you bank with your bank, set up a pack. What that means is a day, you can schedule it for any day of the month. You can schedule it for a day after your paycheck. So before you pay your bills, you've automatically transferred a set amount into your savings, into your TFSA, RRSP, whatever that might be. So you don't have to think about it. And you can increase it. Say you get a pay bump, you can increase that as well. When you go into your bank, I just having worked at the branch, each bank is different, each branch is different, each person is different. So whoever you talk to, they might be called a financial advisor, a financial services representative, banking advisor, whoever they might be. Depending on the knowledge they have or whatever they might have at their mind when they speak to you, do not feel pressured or do not feel intimidated or influenced by any person. Ask all your questions, read all the provided documents that you have, and don't think that any question is stupid when it comes to your money. No question is stupid. Before you spend that dollar, before you put it somewhere in the hands of someone else, at the trust of anyone else, make sure that you understand where it's going. So ask all your questions and research the general features of your investment vehicle. So, TFSA, RRSP, go to the government website, Look at what that means in terms of contribution limits, so on and so forth. Obviously, this is something you could also ask your, your banking representative, and they can go through it with you. That will help you prepare, where you should invest, and it will help you prepare most of your investing in your mind, where should it go? So it'll help you allocate that. Another thing I want to mention is there are no quick rewards. Your investments need time to compound and grow. So if you remember that graph that I mentioned, in 5 years, your investments could do a lot more than just a year. Think of them as little soldiers. The longer you give to themselves, the longer you give for them to fight, the better they will be. So let them do the work. They need to compound and they need to grow. And there are no quick rewards. So, which brings to my next point is speculative investments are no different than gambling, and they tank in difficult times. So anyone who's following crypto, you guys know what happened last week. You know what happened to Luna. It's basically a cryptocurrency. I was reading some guy basically had, I don't know, I don't remember the number exactly, had a significant amount of his portfolio invested in there by, I'm saying thousands of dollars. And now I think last week he put it up on Twitter in a tweet saying now it's worth $1,000. His entire portfolio is worth $1,000. So gambling or speculative investments, there's no guarantee of a positive return. So there are no quick rewards. There are no shortcuts. Investments take time, and you need to give them that time. The last one I mentioned, as with anything, always have a backup plan in case your investments are not doing well. So, say the market is down now and you do not want to withdraw your funds because they will lose, because you'll end up losing. You should have a backup a little bit in cash, as I mentioned earlier, to help you in those critical moments. So always, always, always have a backup. Do not put all of your money in your investments. Always have a cash backup. And, if you talk to your bank, you're investing in a mutual fund or an ETF, they will explain that further. So with that, I'll come to the end of my presentation. There are some links obviously here, just to the contribution limits. You can also just do a simple Google search that will bring you to these. And that basically concludes my presentation. And I'll hand it back to Alam.
Thank you so much, Fahad, for that insightful talk. Now we'd just like to begin the Q&A portion of today's session. I know we have a few minutes left, so we'd like to hear from you, our attendees. If you have any questions for Fahad, please use the Q&A text box to send in any of your questions. I know some of them have already started coming through in advance. I'll start with a few. I know we talked about the different platforms. I think there was a question over here. For a new investor, what would you recommend, Wealthsimple versus Questrade? And are they both safe and reliable platforms? And then they just had a question around whether, we know banks have been around for a while and potentially they'll continue to stay around. But what if we invest in RRSP, something like that? Is there any reliability that these platforms will stick around 40, 50 years down the road when we need the money?
That's a great question. So basically, your banks, the money that you put in your banks, they are invested by this organization called CDIC, so Canada Deposit Insurance Corporation. Basically, any money that you put in any accounts in a financial institution in Canada, say it's Questrade, say it's iTrade, Wealthsimple, whatever it is, they are all insured by CDIC. And they should, the next time you go into your bank or or any of these websites, they have that purple sticker with the CDIC logo that tells you that is insured. So yes, they are safe. Yes, they are regulated, and they have been around enough to build a good, successful track record. So they are absolutely viable options for anyone to start investing.
Awesome, thank you. The other question that submitted earlier, and I'll bring that up. If you're a low risk investor, is it recommended to invest in mutual funds through a bank?
I would say yes. Again, depending on your risk and how much time you have before you might need it. Banks may offer a good option in terms of mutual funds. So say you are a growth investor, you can take a lot more risk. They may have a product for you, a mutual fund for you that's like 80% invested in stocks. So if you had $100, $80 would go to stocks, $20 would go to bonds, or 10% cash, whatever that might be. So I would say if you're a low risk investor, you could start with your bank. They're more than happy to set up an appointment and talk to you. Obviously, do your own research as well. more than mutual funds, personally, I would recommend ETFs because they are free. You can do a lot more research on your own for them, and they can be traded easily. With a mutual fund, you have to, if you set it up through your bank, every time you need to take money out, you have to go through them. So you have to go to your branch and, ask to take money out. So there is that as well. Like access gets a little bit easier with ETFs versus mutual funds.
Got it. Thank you so much. Just briefly, if you can just, I know you were talking about that the markets are quite volatile. So what investment tips and strategies would you suggest with this market being as volatile as it is in these times?
I would suggest, try doing your research on basically defensive industries. What that means is, say, utilities, right? Everybody has to pay their bills. So, Capital Power, Hydro One, Toronto Hydro, they do well when in times of high inflation, in times of volatility, they seem to do well. They seem to hold up well. That's what they're called, defensive stocks. So you can look at those. You can look at, non-stock options as well. So Government of Canada bonds, municipal bonds, or, corporate bonds that do well. Obviously, you do have to lock in your money for a while to earn that interest, but bonds can be a good option in these times. You can also look at commodities, the gold market. Obviously, there are ETFs and mutual funds that focus on these as well. That can be a good option too. So definitely, I would say don't go all in with stocks. That would be my strategy at this time.
Awesome. Thank you. And I was just looking at some of the Q&As, and there seems to be, perhaps I feel like, what's your general take on cryptocurrency and the risks associated with such investments, and any insights you can provide on that aspect?
Yeah, so with crypto, there is, like I said, it is speculative. So personally, I would equate it to gambling. Essentially, there is no guarantee of a positive outcome. Say you invested in Bitcoin a long time ago, depending on when we would be having this conversation, you may have done very well, or you may have lost everything. So crypto is very speculative. There is value in looking for alternative investments, but I don't think that value is there for the average person who, is doing a lot of things in their life. They're working, they've got family commitments, so on and so forth. There's not a lot of value to be had in crypto for the average person, in my opinion.
Great. Thanks for sharing that. I'd say another question over here was, can there be a more intermediate session on investing in the future, i.e. cryptocurrency, how to pick stocks, mutual funds, ETFs? I don't know, Fahad and the rest of the team that's on you on, if you have the appetite to host another session for intermediate level, that would be great. Looks like there's some demand for it.
Yeah, maybe we can discuss that and make it happen.
Definitely. Another question, I know you talked about a little about this, what is your take on commodity market? I know you slightly mentioned about natural resources, but what just generally more than just natural resources, gold, silver, semiconductors, how should people approach these types of commodities?
Yeah. So as far as I know, access is like directly investing in precious metals it became a little harder because all the big banks are trying to get out of it. I know Scotia just got out of it. I think some other financial institutions are trying to get out of precious metals because not a lot of people buy actual gold. So like physical gold that they would keep in a vault at their bank. So now what people do is they have ETFs, they have mutual funds that focus on building a portfolio that has companies that invest in semiconductors, for example. Semiconductors are basically companies that focus on mining materials that go into producing your smartphones, your computers, so on and so forth. There are companies that focus on that. There are ETFs that do that. There are mutual funds that focus on that too. So I think it's a good option. Obviously, that should not be your entire portfolio because the returns on that may not match what they might be in equities, like in traditional stocks. So that can be a part of a good portfolio, but it might be a small part or a risk hedging part.
Awesome, thanks. I will ask one last question. I know there's two questions, but one last question. I'll rephrase it to put it this way. Can you, off the top of your head, what are your top three specific mutual funds and ETFs that you would recommend and keeping an eye out right now? Top three.
Yeah, ETFs. I would say the S&P 500 ETF. There is a ETF that tracks that index. There's one on the TSX side too in Canada. Basically any ETF that tracks the top companies in the index. Any ETFs that do that, I would recommend in the long term. Mutual funds. All banks typically have like a growth or like a balanced growth sort of mutual fund that might be in their name. So in Scotia, it might be, the dynamic edge balanced growth portfolio, which means your investment might be 60% invested in stocks, 40%, or, I would say more like 20% invested in bonds and 20% in cash. Now, if it was growth portfolio, if that's in the name, then that would be, more close to 80% in stocks, maybe 10% in bonds, 10% in cash. So any of these, depending on your situation, are good. I would say one thing I didn't focus on much was the MER, which is the cost of it. Like it's a certain percentage that banks charge. It's different on each bank. So just ask your advisor. Any of these should be good to go.
Thank you all. Thank you so much. And thanks everyone for sending your questions in. What a great session it's been. And thank you so much again for joining us today. Fahad, do you have any final words of wisdom to share with our alumni audience today?
Yeah, I would say keep learning. There's a lot when it comes to investing that you can learn. It will never stop. No matter how many books you read, no matter how much you ask, no matter how many questions you ask again and again. Sometimes definitions in investing change depending on the time. And sometimes you may learn something from your friend that you may need to validate. So always keep researching, always ask questions. No question is a stupid question. Like I said, before you spend that first dollar, before you put it somewhere, understand what you're putting it into, and stay away from any get-rich-quick schemes. Any sort of speculative investments, stay away from them. Crypto is good. You can read about it. There's a lot of good memes that come out of times when crypto is not doing well and when it's doing well. So you can look into that, but do not start investing a large amount of money in crypto or anything speculative. That would be my final word.
Well, thank you so much for sharing that. And I think you hit the mark where about learning. As they say, learning is a lifelong journey. So definitely. Thank you again. You can now turn off your microphone. Really appreciate the presentation.
Thank you.
Well, folks, this marks the end of our session today. Please take a moment to share in the Q&A function what aspects of today's presentation you found most meaningful or helpful, and also perhaps if you have any feedback in general. I'll just give you guys a minute to share some of your feedback. As you all are putting in your feedback in the Q&A, thank you. Sounds like people really found this session great and very helpful. So thanks. I mean, all thanks to Fahad for coming out here and doing the presentation. Really appreciate it. Thanks to you all for your feedback. I hope you found today's session insightful. We look forward to seeing you at more of these gratitude sessions this fall. For more information and to register, visit alumniandfriends.yorku.ca. Thank you once again. Thank you all once again for attending today's gratitude event, and take care and enjoy the evening.